Welcome to our second self-employed home buyer webinar. For those who are self-employed, thank you so much for taking time out of your schedule and joining us tonight. Hopefully tonight I will provide enough information for you to find out how to buy a home as a self-employed person. If you don't know who I am, my name is Min Win with What's a Mortgage, and I am hosting this night's training, but also with me my co-host, Kina DeSantis from Reframe. So she's my real estate partner who I do pretty much everything with, and she will go ahead and empower you guys too on how to find a home in today's market. Go ahead, Kina. You take it
Hey
off.
guys. Hey, I'm Kina. I run the real estate brokerage Reframe here in Southern California. We've got a network of agents in different states. We've got some agents probably on this call too, but if you guys have any questions, send them in the chat. And I've also got my team on here who will help answer some of those questions.
Okay. All right, guys. Let's put your hands together. Ah, my name is Man. I gotta hype myself up sometimes. All right. Woo, woo. All right, ready? Let's rock and roll, guys. Tonight is our home buyer webinar for self-employed. If you are self-employed, I am talking to you. In tonight's webinar, what we're going to learn, self-employed doesn't mean you need to kiss home ownership goodbye. A lot of us feel that way, right? We have a choice. Do we buy a home but we have to owe money to the IRS, or we don't, or we write off everything and we don't buy a home. Anyone feel that way? Let me know in the comments if you do feel that way. That's what a lot of self-employed people go through, and they have to make a choice. But today, you don't have to pick one or the other. You can have both. So, first, if you don't know, this is me. This is me. We dress up as the Adam family one year. And then there's my son right there, thing, and then my wife, right? She dressed up as Wednesday, and that is our house. So that is our house we bought in 2020 during COVID. Okay. And we made one big mistake in 2020 when we bought this house. We were not well prepared. So when this house landed on our lap, we made one of the biggest boo boo mistakes. We filed with the IRS, but we did not take any deductions just so we can qualify for it. So after we bought the house, we agreed to make a payment. And as we're making the payments on this house, I realized, oh my gosh, the money I was using to make payments on this house, I could have put it towards the principal of the home. And with what the monthly payment is, that's the difference between my rate now and my rate, my payment without with my taxes. When I would pay the IRS and taxes, I'm like, I could have kept it because the difference wasn't that substantial, and I didn't know that. And today, I don't want you guys to go through that same scenario as well. So don't end up like me and be rushed. And that's why we're going to educate you so you don't have to be rushed and make a bad decision. So here's our agenda tonight. We're going to go over credit, down payment, income programs, the home buying process, and the do's and don'ts. Okay. So also, guys, don't worry about taking notes tonight because this information will be emailed to you the next day. All right. So let's go over credit first. So credit guide for home buying, understanding credit and its role in mortgage qualification. So your credit section is broken down into credit score, obligations, and your debt to income ratio. Right. So credit score is pretty much your grade. A credit score measures your track record of managing debt. Credit score ranges between 400 to 850, with the higher score indicating a stronger credit worthiness. Mortgage lenders use credit scores to determine your loan obligation and interest rate. So your score pretty much tells the lender your behavior on how you deal with debt. If you do well with that, you have good credit, they can entrust you more with a lower interest rate because you're a lower risk and they're not expecting you to bring in a big down payment. And if you don't have the great credit, they're going to higher rate and also they expect a bigger down payment. All right. So that's why score does matter. So these are the things that determine your score, your payment history, your credit utilization, okay, your credit, mixed credit. If you have different types of credit or just one time, and then new credit. And that's why I recommend a lot of times we don't run credit over and over again because that does affect 10% of your credit. So if you do have good credit, great. If you don't, if you follow these steps here, you can improve your credit. If you're like, hey, man, I need credit help, please reach out to me and my team and I will dig in deep with your credit, see what we can do to improve your payment history, your credit utilization, your length of your history, right? Length is big. Length means probably more than you think. I actually think it's more than 15%, but they put 15% here, and then 10% for mix and 10% for new credit. Okay, so lenders, what do they care about? They want to. You're gonna have when you buy a home, when you run credit. There's Experian, there's Equifax, and TransUnion. There's three bureaus that will run your credit, and the lender's gonna use the middle score. So if you have a 700, 710, or 740, they're gonna use the 710. And if there's multiple borrowers, they're gonna use the lowest middle score. So if you have a 710 and the other person has a 690 as their middle score, they're gonna use the 690. But when you're doing a self-employed loan, I highly recommend you have a 680. Okay, because self-employed loans do have higher interest rates, and we want the lowest rate possible, least amount in fees. 680 or better is where you want to live. If you plan on buying now, we got to attack the credit right away. If you plan on buying later, we got structure so that make sure you have that 680 when you're ready to pull the trigger. Okay. So when you run credit, there's two types. There is a soft pull versus a hard pull. A soft pull affects only your information. It doesn't affect your score, and it's great if you're in the early stages when you're trying to figure things out on which type of self-employed program you want to go with. But if you're like, Min, the house of my dreams just fell on my lap. You need to do a hard pull when you need it to apply. And a hard pull, like I said, you saw that 10% affects your credit by 10%. So we don't want to pull it over and over again. Your credit is good for 90 to 120 days. After 120 days, they're going to have to pull it again. So here's parts of your credit, right? The debt you have. So when you have credit, there's debts that count against you. When assessing your credit, your lender evaluates your monthly obligations. The debts affect your ability to qualify for a mortgage because they add to your monthly debt to income ratio. So when you're thinking about debt, you got to think about revolving debt. Your credit card, the minimum payment affects your debt. But with self-employed, your credit cards, if your business pays it and it's on your personal credit, you can omit it as long as you have proof that the business pays the debt, which a lot of you guys have. So as long as you document the proof, you can omit it. But please do me a favor. Let's say you have a car payment that's paid by the business. 9 months it's paid by the business. 3 months you actually cut out your personal. They can't omit it. They need a clean 12 months proving that your business pays it. Okay. Your mortgage counts against your debt to income ratio. If you owe money to the IRS, that might not be on the credit report, but that monthly payment counts against your debt to income ratio. Also, your installment debts, student loans. Like I said, installment debts, if it's business, you're fine. If not, they have to count it, right? Derogatories, and then anything court ordered. A lot of business people get sued. So if you're getting sued by somebody and it was court ordered and it shows up on your credit report, they have to count that against your debt to income ratio. So understand that when we look at the overall debt, the most important thing for a self-employed person is that when you look at these debts, what debt does my business pay? Okay. If your business pays it, now you can take a sign of relief because you can omit it now from your debt to income ratio. Hopefully this helps you guys out understanding that. So obligations that the lenders don't care about. They don't care about your personal insurance premium. They don't care about your cell phone bill. So if you guys have a bunch of burners out there or any family plans with a bunch of other people paying on it, they don't care, okay? Utility bills, subscriptions or memberships, and other occurring expenses that are not court ordered or not ordered by the government, they don't care, okay? We're looking for debt that's on your credit. If you have business debt and your business is paying for it and it's not on your credit, they don't care. It's already, they're not really looking at that. They're already considering that as an omission, okay? Also, when you're doing your budget, now we have to look at your debt to income ratio. So when you are qualifying, just know that for self-employed, it's a 50% debt to income ratio. So if it's just half, so let's say if you make $20,000 a month in as a self-employed person, as long as your mortgage payment with all your debts that you can't omit is under 10,000, you will qualify, right? Here is how it works. It's your DTI is your gross income divided by your obligation. So let's say you have 2,500 bucks a month in your obligations. Okay. Let's say you have your mortgage payment, all your expenses, take it by 2,500 divided by your income. That's your debt to income ratio. At this example, it's 42%. So you would still qualify with this formula with those numbers. Here is your debt to income ratio cheat sheet. You can go to 50, but some people, they don't want to go to 50. They only want to go to 45 or 40. This is without debt. Of course, if you have debt, you got to add on to it. All right. You'll get this in your email as well the next day. And bonus tip, let's say you're like DTI is too high. Different ways to bring down your DTI: increase your down payment, pay off some debt, reduce the purchase price, or add a cosigner. Okay. A lot of you guys who are self-employed, most of the challenge I'm seeing is not the debts, or actually the debts that you don't have proof that the business pays it. I've seen so many people where they've had, for some reason, the business pays the car, and that's the probably the number one. The business pays the car, but for 1 month or 2 months in the 12 months, you decide to cut a check out of your personal bank account. If you do that, it just resets until you have a clean 12 months. So make sure that when you sit with Mitch, who's my right hand, with our self-employed home buyers, that you sit with Mitch and you're honest with him. We've had buyers drag it to the last minute where they don't want to show us the proof that oh yeah, my business pays my car, which just happened, and at the tail end it didn't, and they have to pay off the car now because they're at the final minute. Okay, so you do not want to do that. So here's a key takeaway for credit for self-employed people: 680 credit score or better. All right. You want to stay in the 680 credit score. You want to make sure that you understand your debt to income ratio. What's the number one thing? Make sure your business is paying your debt. If not, you have to count that against your DTI. All right. And we showed you guys it's at a 50% DTI. And of course, I've already given you the information on how you can lower your DTI to qualify. All right. So now let's talk about income. A path to home ownership for a self-employed person. Being self-employed shouldn't hold you back from owning your dream home or investment property. Okay, we're also going to go over this DSCR program. Unfortunately, self-employed individuals often face a hurdle because they deduct so much of their taxes. While deduction helps you follow tax rules, they can make your income low look smaller to lenders, creating challenges when you apply for mortgage, which is why a lot of you guys are here, and a lot of you guys I saw in the comments, you aren't buying a home yet because you are in this situation. In the past, many self-employed people had to reduce their deductions to qualify for a mortgage, leaving them with hefty IRS tax bills. But not today, guys. Not today. Today we are going to win. We're gonna keep our deductions and we're gonna buy our house. Who's with me today? Me, right? This guide is here to show you how you can buy a home without sacrificing your hard-earned tax deductions. These are the rules, and you guys are playing by the rules, but now they want to penalize us. Okay? Freedom! So, us using specialized programs designed just for self-employed buyers. Okay? So, these programs are made just for you, and you. All right, guys? So, here are the programs we're going to focus on today. We are going to focus on a profit and loss program using P&Ls to determine your income. Okay? Great for people who have fluctuating income. Then we have the 1 year self-employed program for those of you, you know what, you just became self-employed, right? It's only been a year because you left your W-2 job, like, I finally did it, right? You can still buy. You don't need to be self-employed for like 5 years. But the more years you have, the better. Then we have our asset depletion program. For those of you guys, you have a lump sum of money and you're like, you know what? My bank statements aren't showing it. I don't do all the deposit. I run a cash business, whatever it is. You have your asset depletion. And then for all of you 1099 independent contractors out there, there's 1099 programs as well. Okay. And of course, our popular bank statement program, which is the one that 95% of self-employed people do. And last but not least, for all you guys who are going to buy your house the first time, great. These programs are for you. But for those of you guys, I'm ready to start buying investment property. We're going to go over the DSCR, debt service coverage ratio. This is how self-employed people are building wealth through real estate. They're buying investment properties. And then most of the time, back in the days before this program, you couldn't write off everything on your rental because if you do, then you won't qualify to buy your next rental. Now, you're just buying rentals and you don't even care what you deduct anymore. So that's a beautiful thing to hear, right, guys? Keeping your deductions. So let's go with asset depletion first. Asset depletion program allows borrowers to qualify based on their liquid asset rather than traditional income. So when we're looking at this here, you can use your savings, investments. Asset needs to be in your account for 6 to 12 months. They go off an 80% loan to value. That means with this program, you need 20% down. They'll go up to $2 million. Okay. How does it work? They're going to take your assets and divide it by 60 months. For example, I have a borrower. Actually, she actually wasn't even self-employed. She was going to UCI, but she was a sugar baby. I know it's crazy. This guy left 500 grand in her bank account. So we took the 500 grand and we divided by 60 months. So that's 8,333 as income, and we have that 40 to 45% debt to income ratio. If we kept it under 45, her payment was a lot better. But that's how we did her analysis. Okay, so this is great for people who you have a lump sum in your account and you don't or you haven't been tracking your money. This asset depletion is great for you. Okay. Next one, profit and loss. Okay. Self-employed for at least 2 years, providing a P&L statement prepared by a licensed tax preparer or CPA, and they want a credit score of 700. You can go 10% down sometimes, or actually, there was a lender that's doing 10%, but most of them are doing the 75%. But there might be one or two, but I know that the rate is not the best. I don't recommend it. All right. So option here, you can go an audited or non-audited P&L. The audited one, of course, will have a better rate than the non-audited one. But the one thing they both have to have, 3 months of the bank statement must align with your P&L. So don't get too quirky with this thing. They want the last three bank statements to like match your P&L, okay? And your loan to value, they do typically want 25% down. There was a lender, we did one a couple years, I think like last year, where they did 10% down. They go up to 1.5 million, and this is for owner occupied only. You cannot go investment or second home, right? So it reflects actual business income without your deductions. You are good to go to buy this home now and not worry about it. Just go off your P&L, which a lot of people are doing now. Our third one year self employed. So you can go 1 year tax returns, 1 year 1099s, 1 year bank statements. Pretty much, they will accept the fact that you've only been self employed for 1 year. So if you've been self employed for 1 year, you don't have to wait, oh, let me wait 2 years. No, you can do it after 1 year. Okay. If it's a license, a business that needs license, you want to make sure that license is a year old. We had a lady who, in her business, her license wasn't a year old yet. Even though she interned and helped out, she's had her license for only 1 year. All right. So you need 1 year, 660 credit score. And those are your options like at bank statements, P&L, 1099, and they will deduct. Here's the most expensive and most important thing. When you go self-employed, right? And they do deduct 20% for your expense ratio if you have minimal employees. But we had a client that had a lot of employees. They will go up to 50%. So they'll take your income divided by 12, either subtract 20% or 50%. And that's your income you can use to qualify, right? And the 1099, like I said, for you contractors, real estate agents, if you move money around a lot, or sometimes you deposit this account or that account and you can't track it all, they will go off your 1099. All right. If there is a substantial increase over a period of time, and it's from the same employer, or whoever's contracting you, make sure you have a solid letter saying that why did it jump. We had a lady, she was a contract nurse. She went from 180 to 250 in 1 year. Okay. She was able to document it all, and we were still able to use her income. All right. Last but not least, we have our bank statement program. This is the most popular. Pretty much 99% of people use this one if they're self-employed. There's a 12-month bank statement. Well, they'll average your bank statement for 12 months. There's a 24-month bank statement. Okay. The 24-month will give you a better interest rate. But a lot of people like to go 12 for some reason. But if you can go 24, go 24. But if you look at your deposit and it doesn't look amazing, in the last 2 years, then I would just grab the 12. Okay. Credit scores may vary, but like I said, 680 is where you want to be. All right. And same thing with bank statements I didn't have on here. Expense ratio. If you don't have a lot of things to store, you don't have employees, 20% expense ratio. Anything more than that, make sure that if you go to if you have to go to 50%, just understand that it's going to cut your income, right? We had it happen to a client, and this is why I highly recommend, because these programs are getting more popular, have a lender, have an underwriter review your bank statements and sign off on it before you go out there and start shopping, all right? So, of course, now we talked about all our owner occupied programs. We have our 1 year self employed. We got our asset depletion. We got our bank statement programs. We got our P&L program. So, with all these programs, the most important thing, you still kept your tax deductions. Okay. Keeping your tax deductions, buying your home, right, is a possibility. Yes, Sometimes down payment might be 10% down or 20 to 25%, which I'll give you the matrix in a little bit. But now it's a possibility. But I'd rather put a bigger down payment than pay it to Uncle Sam because I minimized my deductions. All right. So last but not least, we have our DSCR loans. Okay. Our DSCR loan, debt service coverage ratio loan. Give me 1 second here, guys. Is this Keenan? Okay, setting for, all right, cool. DSCR loans. So with our DSCR loans, it's debt service coverage ratio. So with this program, they go off your rental income. So as long as your rental income is more than the mortgage payment, they will loan you the money. So this is why you're seeing more investors buy real estate. They're not looking at your tax returns. They're not looking at your rental property on and all your deductions. They're just looking at the next home you're buying. Okay. So this rental income, as long as you take the rent, you times it by 1.25% for the best rate or just 1%. And that should tell you for example, let's say your mortgage payment is 3,000, you times it by 1.25, that's 3,750. So long as you're collecting 3,750 in rent or more, you can just buy the property. All right. The cool thing about these programs, you can buy it under an LLC. Okay. That means you can buy it and protect yourself because if anything happens to the property, it doesn't affect you directly. You still have to qualify with your credit, in case you don't make the payment. But the LLC allows you to buy these rental properties and not take on the liability you would buying it in your own name. Okay. Also, with a lot of these programs, when you put in LLC, the lender might call the note due, but with these DSCRs, if you're going to become a landlord, they prevent with this program, they allow you to put an LLC and they're not going to call the note due. Right? That's why it's an amazing program. Also, now they also do short-term rentals as well. So if you're going Big Bear, okay, Joshua Tree, parts of anywhere in Colorado, that's a vacation, and you can collect Airbnb. You can use that as income, right? So like you just have to talk to the lender and let them know up front so they can help package the loan correctly. So here's the down payment cheat sheet right here. 10% down programs, 15, 20, 25, 30, depending on what you're getting. All right. That will also be in your email. And here's the guideline programs here for you for the loan amount here. This for the P&L program. All that's here for you for P&L, asset utilization, 1099, and bank statements. And the LTV on here for you. All right. I also left it here too for the DSCR programs, what you have to put down for DSCR. So we have here P&L, tax returns, utilization, all that. And then we have our DSCR programs. Okay. So now we're talking about the home buying process. So with the home buying process, it's 9 steps. Step number 1, you're going to talk to myself or Mitch, get yourself approved. If you're ready to move forward, we run credit. If not, we can do the soft pull, help you organize yourself so you're ready. Step 2, find a real estate agent. You don't need to look further. You have Keena DeSantis, her and her team. They're like amazing. I say they're number 1 in Orange County, because they know what's going on. They also do LA, Riverside, San Bernardino. I think they do all of California, which I'll have Keena go into it for you. Then when you find a home, you go into escrow. Once you go into escrow, there's conditions that come out. You clear your conditions, you order your appraisal, you lock your loan, then you sign loan docs, you send out your wire, and boom, your loan is closed and done. And we celebrate. All right. And next, of course, we have our here, I actually did the breakdown here for you. I was actually doing it faster. But here's a breakdown in details. This will also be in your email as well. Okay. So no taking notes. Also, make sure as you're out there buying a house, you have these do's and don'ts. Stay consistent with your work. So if you're getting deposits, right, do it correctly, right? Put it in the same account. I see so many people, they keep moving money around, guys. Don't do that. If you're going to buy a house, especially self-employed, business accounts. Don't just go, well, this one goes here, this one goes here. Oh, I make X amount. Make sure it goes from the same account. Make sure life's easy, okay? Also, guys, what I would do is every time you get a new bank statement, as you're shopping and you haven't closed escrow, give it to the lender. Help Mitch and I out. Make sure that we can see your deposits to make sure your deposits aren't declining, all right? Okay? So save money. Some of you guys thinking you're buying a house, it's not there. You're out spending money like crazy. Save your money. Pay your bills on time. It's important that you pay your. I think you put pay your bills on time twice, which I got to delete here. And then do not answer calls. Okay. A lot of times, what happens if you have a collection? Be careful. A collection company might call you, might answer, say your name, and then they'll put a mark on your credit because you answer the call and you acknowledge that you have a collection or that they know who you are. So be careful, okay? And the most important dues, please refer us business because we are on a referral based system. All right, guys? Oh, also then my checkpoints here, things to be on top of as you're out there shopping for a home. And that's it. So that is my side on the lending on how to buy a home as self-employed. Hopefully, you know, now you feel more confident that, hey, you can keep your deduction. Let's say it together. We can keep our deductions. You can still buy a home, get an affordable payment, and be a homeowner. Okay. You don't have to kiss home ownership goodbye. With all these programs, with my guidance, with Keena's guidance, home ownership is just right there at the tip of your fingers. All right, guys. Thank you guys so much. And next we have on Keena DeSantis.
Hey
Ah!
guys. Hey, okay, so some of you in here are realtors, some of you have already bought a home. Buying a home, whether you're self-employed or not self-employed, isn't that different on the realtor side of things. On the lending side, it's very different. So you're probably really digesting what Min just told you. I'm going to make this easy. I'm walking you through the home buyer process. I'm going to give you some tips, some tricks, and actually some realtors have liked some of the things that I've said on here. And so I get some nice messages if you guys want to follow along too. I am going to share my screen with you right now, and go through this with you. Okay, let's see here. All right, let me know. You guys can see my screen? Awesome. Okay, so this is the self-employed home buyer workshop. We're going through the actual home buying process. Min talked a little bit about it right now. I'm going to give you a bit of a background about me too. Um, we're going to go over the process, what to avoid, some mistakes that you don't want to make. Something to know about us is we've helped a lot of first-time home buyers. I know you guys aren't all first-time home buyers, but what does that mean? We're really focused on education. And a lot of self-employed people are really focused on that. And that's something that we like to also focus on. Our philosophy is we're going to give you the information and you guys are going to be able to make your best decisions. Um, we've helped over we've helped buyers this year over $1 million of home buyer grants. And actually most of that's what we've done with What's a Mortgage. So we really love working with Min's team. And these are some of my agents. We're a team of 10. We're based in SoCal. We've got some other agents on this chat. I know I saw somebody in the Bay Area. If you guys need help finding an agent, you can reach out to us. I was a 30 under 30 for the Realtor Association. So I have access to some really amazing agents across the United States. Um, First, we're going to get into the home buying process. Let's get into it. So we call this our buyer foundations. Min walked you through the actual process of, from the beginning to the end. This is even before you start. This is like today onwards. Some of you aren't looking to go buy a home in the next 3 months. Some of you just want to get an idea of the process. Maybe you're thinking next year. That's great. What you're doing right now is you're learning from what we're sharing with you, but also having a real estate agent and a lender who can then learn about you and what is going on in your life is really important. As business owners or people who are self-employed, our income is so variable and every situation is different. Like you saw in Min's talk, there's so many things that you can optimize. Even me, as a realtor, when I buy a property, I get pre-approved way in advance. I give Mitch all my documents and I'm like, hey, I'm thinking in the next 6 months I want to buy a house. Let's just get things going. Because there's a lot that you want to optimize and you have to time that with filing taxes, how you do everything. And it's really important to start earlier, more so than if you were just a regular W-2 employee. Two, or that's the knowing your numbers, right? So first is that conversation with a realtor or a lender. It can be one or two, two then one, but you want to have those two conversations in advance because you want to assemble your team and let them know what you want to do, how you want to do it, how can you optimize, and those are the people who are going to tell you exactly what you need to do to get the best result. After you know your numbers, in Southern California, the difference between 900 and a million could be a 2 or 3 bedroom. It could be a condo or a single family. So having the actual numbers that you want to target is extremely important because then what we're going to do is we're going to set you up with that home search. I told you guys about Real Scout, or I'll tell you guys about Real Scout. Real Scout is a home buying tool, a home search tool where it's collaborative. So I'm on one side, you're on the other. I can send you homes. We can set up a really specific filter. Like if you guys want a home with air conditioning or a two-car garage or laundry in your home, those are all the things that we can filter out for. So we're not missing anything. It's kind of like a filing system, keeps you organized, and it's very collaborative, which is extremely helpful. It's the best tool for finding a home that I've ever seen. Let's get into some misconceptions. So, a lot of buyers, especially first-time home buyers, think you go find your home, then you get your loan. I can tell you, as a business owner, it's not going to work that way. You will likely lose that home because the amount of time that it takes you to get financially prepared to really know your numbers takes a long time before you can actually make that offer. And what you don't want to do is make that offer, get into escrow, and then realize you actually can't move forward on this home anymore. And all of a sudden, your deposit is at risk. That's what we don't want to happen. So that's why we want to reverse it. Let's get the loan, then find the home. Offering, a lot of people also think offering means you're locked in. When you are actually in escrow, you have contingencies that you are allowed to use to pull out. So you have an investigation contingency. You don't want to remove these, especially like I mentioned, if you haven't gotten your loan approval yet. You want to hold your contingencies until you have the green light from your lender, your agent, anybody who's involved, insurance, and then be able to move forward. And that's what actually keeps you guys safe from losing that initial deposit of 3%. You buy a home, you get your offer accepted, you give that 3%, and you don't want to lose that money during escrow. Another thing, people think it's impossible to get your offer accepted. In the past month, at least in Southern California and actually on a national basis for more than just the last month, there's been a major increase of inventory, major increase. So, one, it's easier to get your offer accepted. But what happened today? I was on a call with some of my agents. What are they experiencing? Tons of offers on the top homes. The top homes in the top neighborhood with the best renovations and the best marketing are always going to be in a bidding war. The best properties, people are always going to be buying and selling, right? And so the best units are always going to be popular. It doesn't mean that it's impossible to get your offer accepted or to lock that deal in. It's still a lot easier today to make that happen than it was in 2021, which is important to know because that's when there were dozens, 50 offers, 100 offers on homes that weren't well priced sometimes. They were priced too low. So let's talk about actual tips, things that you can do to make your process better. So, house hunting, how is it going to work, right? Where are you going to get these deals? So, you're looking at Redfin, you're already looking at Zillow, Real Scout, like I mentioned, that's an agent collaboration tool to actually look at the homes. You're also going to get your agent specifically highlighting homes. So, like on Real Scout, I'm sending my buyers all of these homes automatically. But then today I'm like, hey, Tracy, hey, Tom, this one's really good. And it's right next to this hiking trail. This is an actual message I sent an hour ago. It's right next to this hiking trail. I know you guys like to do all of outdoor activities. I think we should double check this one this weekend because maybe you missed it or maybe you just didn't check this week. The other thing is off markets. Another message I sent out today is, hey, we have an off market. It's a 4 bed. It's exactly what you're looking for. Do you want to see this home before I put it on the market? And that's a nice opportunity for my buyers because they can get in without competition. And only really they and a few of my other clients know about it who fit that profile. So, some tips that you should keep in your back pocket, right? When you're working with your agent, they're sending you listings, ask them for the community or the property specifics. You want to know interesting things about this property that maybe are on the MLS, the back notes that only agents see. You want to know if there's any local information that's important. When you're looking at the listings, you're looking at all these beautiful photos. If you see ugly photos, I promise you, take a second look at that one. I found two homes this way. The uglier the photos, the better the deal. Because when you get to a home, you don't know if it's actually going to be ugly or not, right? Sometimes the marketing is bad. Sometimes it's an iPhone or Android photo and there's like a thumb in the way of that camera. That does not mean that the home isn't a good property. It means that the agent doesn't care. And maybe even the seller doesn't care about marketing or they're not motivated. They just want to sell it and be done. They don't want to get the highest price possible. That's how you get a good deal. That's a social hack to get a good deal. And that happened when I bought my first property. It was an amazing opportunity. Another thing, So, like I mentioned, the MLS has information that only we as agents have. You guys don't have access to this info. We have access to it because we are agents and we can see what other agents have told us. What does that mean? It means someone's died on the property, there's a tenant in the property, the seller needs a rent back, they're moving out of state. This is information that's going to give you a fuller picture of what's going on. Other thing is, if it's too good to be true, it is too good to be true. I had a buyer send me a home yesterday listed at 1.5 million. I looked at it and I thought, there is no way this is going to go for under 2. Gorgeous home, overlooks the hills, Laguna Niguel, fantastic property. I'm taking a look at this. We talked to the listing agent. They have dozens of offers. Highest offer is at 2.6 million. Why did they list it at 1.5? Nobody knows. But that's what they decided to do. If it's too good to be true, I guarantee you it is. There's no random little deal. Now, if it's like saving $50,000 on a property that's listed at 900, that happens all the time. If it's buying a home that needs some renovations and you spend 20 on the renovations, it should be worth 100,000 more. That happens. But $1 million off of a price, $500,000 off of a price, it's too good to be true. At least for residential. All right, house hunting. When you're actually touring, you're going to go to open houses, you're going to do the private showings. Sometimes, if there's a tenant in place, they're not going to let you see that home until after they move out or after you write an offer. But remember what I told you, writing an offer doesn't mean much. You can write that offer just to see the house and then update that offer later with the terms that you actually want to offer after seeing the property. When you're going into a home, go in with that open mind, but keep in mind there's cameras everywhere. Sellers are always listening. My sellers are always calling me, telling me what somebody said. Somebody once texted me and they said, "We're going to write an offer." And my seller said, "Heads up, I heard on the Ring camera they're actually writing an offer on another property also. Screw this buyer. We're going to go with the other one." Be careful what you say in front of the cameras. Another thing, when you're at the open house, some people think you walk in and you're like, "I don't like it. I don't like this home. It's too dirty or it's not my favorite color." The listing agent is going to sound the alarm and say, "Okay, this is not the buyer we want to work with. We want to work with a buyer who wants this house." If they don't want this house and they're putting in an offer, it's going to be the worst escrow of your life to the seller, right? So you do want to have that rapport and actually have your agent have that rapport with the listing agent. And also be upfront with what you don't like. As an agent, I like to hear more about what a buyer doesn't like than what they do like, because usually if there's something that they do like, we can make that happen later. If there's something you don't like, we cannot change that. So we want to know what you hate. And it doesn't, it's not complaining, it's actually very helpful for us. All right, let's talk about offering. What happens? You say, "Hey, Kina, I want to write an offer." And I'll go, "Great. Before we write this offer, let me talk to the listing agent. Let me see what's going on. Do they have offers? Are they higher? Are they lower? What does the seller want? Is there anything that we need to know? Let's get the communication line going." I get the information, I text it to the buyer or I send it to the buyer. And then we talk about what terms the seller's looking for. And then we talk about what terms the buyer's open to doing and where, that offer needs to be and what the comparables look like. We submit that offer, we send it out, we, write a nice email to the listing agent and the seller, and then we wait, right? We wait to hear back. It usually takes between 1 and 2 days um, to get that offer back. Now, that's the process that everyone should. Some people don't do that. They just go, "Hey, what do you want to write at?" And they write it and they submit it and they don't even talk to listing agent ever. Tips for actually getting this offer: accept it, right? Sometimes being fast will win the deal. You wait too long, another buyer could come. Sometimes there's been a home on the market for 3 months and we write an offer thinking no one's going to come. This has been 3 months. But then what happens? A day after we submit, somebody else submits. And now there's a bidding war on this home that's been in the market for 3 months. It's totally unfair. It makes no sense. We should be getting way below asking because of this. But if you have two buyers who really want this home, then they are going to be competing for that home. So if you can be fast, sometimes it helps you win the deal and get a good deal. Like I said, competitive on the top properties, but right now is probably a good idea to get a deal as a buyer, with where the market's at. And then, as far as negotiation goes, in order to be fast, you have to know your numbers. So if you get the numbers of, okay, if I offer 1 million or I offer 800, 850. I want to know what 855 looks like or 860 looks like on my monthly payment so I can feel comfortable going up or down or really up, right, to negotiate and get a better deal if I need to. If I need to do that and I need to pay an extra $35 a month, I'll do it because I really like this house. But you want to know it's $35 a month, not $5,000. Um, and how it's actually going to affect you. And the last thing is that you have to love the home. Kind of goes without saying. However, buyers often will feel pressured to buy a home by maybe family, hopefully never the agent, but they just feel pressure. And they might offer an open escrow on the home and then they decide they don't like it. You guys have to love the home. This is a huge purchase, huge purchase. So just keep that in mind to be a little bit picky. All right, last section. What are we avoiding? So, if you're buying a property that you're going to live in, you're not buying this property as an investment property. I do not recommend closing on a home with your tenant in place. It doesn't mean the seller is still in the property. Sellers often stay in the property after close of escrow because they need some time to move out. But an actual tenant in place can be a liability. You don't know what's going to happen. You don't know if they're going to leave at the end of their tenancy. In California, we've got really strict landlord laws and really pro-tenant laws. And so what does that mean? It means you're at a huge liability if you close on the home and the tenant is still living in the property. You want to wait for them to leave. 5 days before close of escrow, they need to be out of the house. Another thing, you do need to ignore homes, or you need to not ignore homes because they need work. My trifecta is flooring, painting, and lighting. If it needs those three things, I know I could spend 20 to 30 and I know I could get 60 to 80 back on the purchase price. So what does that mean? I buy a home for 900 instead of 950 and I put 25,000 into it to make it look like that home that should be listed at 950. So I'm getting a good deal because I'm making the renovations that I want and I'm paying a lower purchase price. Also, you don't want to buy a home in a bad location. Once it's in a bad location, you can't move it. It's going to stay there. If it's on a main road, it's always going to be on a main road. And you might say, I'll settle for this home because of the location. But remember, when you sell, you might get a discount when you buy. You're going to give a bigger discount when you sell. Something to keep in mind. Um, and then, like I said, you have to love the home. Don't buy a home to lock in a home. As far as agents go, you want to avoid the pushy agents. I've never seen a good pushy agent. I don't think it's a good way to do business, and I think most agents would agree. You also don't want to work with agents who don't prioritize real estate. It's scary because 70% of transactions are done by agents who do less than 3 deals a year. What does that mean? It means you're possibly making the biggest purchase of your life with somebody who has only done this twice, maybe in the last year. The majority of people are actually doing that. And so, if you're not doing this on a daily, weekly, monthly basis, then you don't really know what's going on in the market or have a temperature read of what's happening around us when there's so many changes. There's been an incredible amount of changes since 2020, and you really want to work with an agent who understands what's going on and is a true professional. A lot of people do want to work with their family because they're family. I had a client call me this week and they, worked with their family to sell their home. And I asked them about some of the terms and like, Kina, we totally had the worst experience. And now we need to buy a home. We cannot work with them again. Can you please help me? And but the problem is they probably left money on the table from that sale. You could always, if you want your family to get paid, work a referral fee out with your agent. Have your family member refer you to a professional, strong agent. I'm sure the agents in this chat would also agree too. But you do want to work with professional agents who work in your area and are constantly, consistently selling and buying homes. As far as lenders go, 9 to 5 lenders, they don't work. If you walk up to a bank, you ask for a lender, you're going to get a lender who works from 9 a.m. to 5 p.m. Monday through Friday. What does that tell you? That tells you that you're going to end up working with a lender who's not going to answer your call on the weekends. That's why I like working with WHAM. They're around the clock. They are here to represent you. Most of my clients don't have the availability to talk 9 to 5. They want to talk after work. And so that's when really real estate is done. That's when real estate is handled for buyers and sellers. So that's when you need to actually be able to reach your agent and your lender. You need to talk to a lender who's going to pick up the phone and a lender who's going to give you estimates and numbers. A lot of lenders will say, we're not going to talk to you. Submit your application, we'll talk to you after. Well, that's not very helpful because if you have to submit an application and you have questions, who are you going to ask those questions to? This is especially important for people who are self-employed because a lot of agents and lenders don't understand non-conventional regular loans. So having that lender who understands the inner workings of a self-employed buyer is really important. Last step, this is how you can connect with us. This is my team. So cute. We have a buyer guide we can send you guys. You can find us on Instagram and TikTok. And if you have any questions, let us know in the chat. And now I'm going to bring back Min. Hey, Min, you're muted. But we can feel the excitement.
Excitement. I said thank you so much, Kina. Didn't you bring some great information, even those who are real estate agents here? Didn't you learn a couple nuggets now that you can take back and help your clients out as well? So thank you so much, Kina, for that. And guys, also, if you need to get a hold of our team, my right hand, Mitch Lasser's here. He will be reaching out to you guys to kind of go over the steps on how to prepare yourself. Now that we know, hey, there's all these different programs, which program best fits your needs. So he's going to call you, go over with you, hey, here's your option and payment option number one, number two, number three. We want to make sure that you have the option that best fits your needs. So look out for that phone call. Also, if you didn't take notes tonight, it's fine. You will be getting an email tomorrow from us on everything we went over with you. Also, we have our full self-employed home buyers guide, which is about 20 more pages longer that I've attached I will be attaching in the email as well. But that being said, thank you guys so much for signing on and hearing us talk about how to buy a home as a self-employed person. So, also, is there Q&A, guys? If anyone has questions right now, please ask in the chat. Or did Joey already answer most of these questions?
I see Joey and Mitch being super fast, Jessica too. Thanks, Gloria. Glad that we could be helpful. Does the same apply for a fourplex? Don't buy it with three tenants and the owner. If you buy it with the tenants, anytime you buy a property with tenants, you need a estoppel certificate. So anything that the past landlord did wrong, you don't want to be liable for that if you want to keep them in there. Most of the time when multifamily is being turned over these days, it's not being turned over because it's a great performing asset, right? It's being turned over because the rents are low, work needs to be done, the seller died, right? Sellers die, owners die of these rental portfolios, and then they sell off a bunch of these properties all at once. And so they're estoppel, Estoppel. Um, so they're dying and then selling a bunch of portfolios. And so they've sat on these portfolios. They haven't increased their rent in, 20 years, and now they're paying a third of the rent that they should be. So there's a lot of cleanup that needs to happen when it comes to multifamily. You have to be really careful and really sharp, and work with an agent who does multifamily or invests in multifamily. Bigger Pockets is a good resource for that too. But there's also the FHA loan, right, for multifamily men.
Correct. But with that, of course, you can't be self-employed. So unless that one, you would have to show income on your tax returns to qualify for it.
And also the
This is why we
FHA
need a
one.
lender.
Oh, I was gonna say also for the FHA one, if you get past two units, it must be self-sufficient. So that tends to be a thing that can sink a lot of multifamily for three or four. The rents for the property basically need to cover the mortgage with a little bit of adjustment in there. And so the problem is if you have like a big three or four unit where the rents are really high, it's probably also really expensive, which means the mortgage is high. So now you have this problem where it might not qualify. Conventional actually just started doing those big multifamilies as well, where you don't need that gigantic down payment as long as you're occupying it. They do not have the self-sufficiency rule. So I can go into that in a lot more detail if someone's interested, but conventional just became a lot more competitive for those multifamilies recently.
So Mitch brought that up. What I mean by your self-employed income. So a lot of you guys deduct everything when you're in the negative. So if you're trying to buy these units, you can't go negative because if you're using the 75% of the fair market rent, on conventional or FHA, if you do meet the self-sufficient and qualify, I would definitely make sure that you're not going so deep into your deductions where you're in like the negative, because that negative will carry over as like a credit card hit as well. Like say you're negative 12,000, now you're pretty much negative $1,000 a month. So be very careful if you're gonna get units, if you're gonna use the rental income to qualify, that you don't go so deep in your deductions. Besides that, I think that's about it, guys. I once again thank you guys so much for spending time with us tonight, and we will talk to you soon. And look out for our phone calls. All right, enjoy the night.
Bye.